The Chinese market has been looking very oversold, as has iron ore, so not surprising to see a bounce at these levels. We'll have to wait and see whether it is a dead cat bounce. The volatility that we're seeing in the markets is just absolutely astounding. The fact that we saw the Shanghai Composite opening up down 3.8% and then really making gains of about 2% during the afternoon session. So a stunning turnaround, and these swings of 6% in one day, really hard for investors to digest. Of course, if we have a look at our material space, this is a space that has been looking the most oversold in terms of sectors on the Australian market. So a stunning bounce there with stocks like Fortescue up around that 6% mark, and this was on the back of iron ore futures in China, pointing positive, pointing to a good session in the US tonight. So the material sector saw the most stunning turnaround in terms of the Australian market, but just tentative signs of stability in terms of the Shanghai Composite really helping markets around the region today. I mean, it was an amazing start in the morning. The Japanese market lost more than 2%. The Australian market was down in the red, with a lot of our miners down around that 1.5 to 2% mark. And then in the afternoon, a turnaround. Now, yesterday we did see China introducing some new measures in, and that is that any major shareholders with a holding of more than 5% and directors and executives cannot sell stock. And that seems to have helped stabilise. There were also reports around that corporates were buying up stock. So it's been an incredibly volatile ride. And I think for the Australian market, China is very important to sentiment, and especially to that material sector, which almost has this symbolic link, if not an economic link, with what's happening in terms of the Chinese market. Just having a look at the Shanghai Composite, and this is a Chinese market over the past year. So you can see it's been an incredible run from the beginning of the year, where the market was just over 3,000 points, to the market going over 5,000 points, and now coming back to about the 3,700 point mark. But looking at China's market over the last 10 years, and you can see that, this volatility is nothing normal. The big question is the end of the correction here, or are we going to see something more similar to the global financial crisis, where we did see an initial bounce, but the market continued to fall? So the big question is this a dead cat bounce, or is this continued stability?
On the sidelines?
I think the problem with this scenario at the moment and the volatility is that it could go either way. It's very much a binary outcome. It's almost like a crash scenario, or the market continues to rally to record highs. Now, if we have a look at what's happened in the past in terms of intervention, and what we've seen in the US example with the Federal Reserve and the money that it's spent, and of course the Bank of Japan and the money it's been spending in terms of buying ETFs as well, is that it's had a positive impact in terms of asset markets. So I guess the big question is this sum of money going to be able to support the Chinese market, as we have seen in other markets, or are we going to see this selling pressure just too big a wall for the PBOC to overcome? So I think the example in other markets does show that when we do see this large amount of money and central bank intervention come in, usually it does support share markets. I guess the difficulty for investors in working out the risks in this scenario is that it does seem pretty much a binary outcome in this type of scenario, where either there's a wall of selling or the central bank intervention is enough to help support the market and see it rally back up. I think we will still continue to see volatility in terms of the banks, so I'd be looking to pick up the banks more in oversold conditions rather than even at the moment. We have seen a strong bounce back for the banks over the past months. Commonwealth Bank, I was happy to pick up around $80, $81. It's still holding up around about 85 to 86, but that would be my pick out of the big four, because on an 18-month yield, it of course has a yield of around about 8%, because it will pay 3 dividends pretty much over the next 13 months. So it's the nearest paying dividend player in terms of the banks. But I guess just in terms of the markets, we have seen some strong bounce backs in certain sectors of the market. From the end of last month, we've seen the discretionary sector bouncing back very strongly. So if you're looking at shorter term trading positions, the material sector certainly is looking oversold and is looking ripe for a bounce back. From an investment perspective, though, it remains more difficult to get into commodities while they are so volatile. So one of the key themes that investors can ride is that lower Aussie dollar. We've seen it in a couple of weeks drifting from that 78 cent mark to having a 74 cent handle, and that's going to be beneficial for a lot of those companies with revenue offshore, especially some of those healthcare companies with those stable cash flows coming through. So there are certain themes that investors can ride, and of course if you have a list of stocks that you have been looking at but have been too expensive, this volatility is perfect for picking up some of that for the longer term portfolio. But from a short term trading perspective, lots of opportunities out there as well because of the big moves that we're seeing, and the material sector in terms of sectors is looking the most oversold on the Australian market.